Hi everybody, Barry Sexton here to talk to you today about the significant tax changes that have taken place over the last couple of years and perhaps give you a couple of tips which might prove helpful. The first is self-employed health check. I would recommend that you do that if you are a self-employed person, as the accounting period for calculating your profits for tax purposes will change to correspond with the tax year. So if you've got a accounting year which is not the 31st of March or the 5th of April, I would strongly recommend that you change that. The likelihood is that if you stick with the old accounting period, you'll have difficulty in calculating your profits going forward. You'll have to use estimates, etc., and that will prove difficult for planning purposes. There's likely, unfortunately, to be more profits falling into 23-24 if you are in that situation, and I would strongly recommend that you look at that carefully. The second is making tax digital. Now that is definitely coming, and one of the major elements of that will be the cash basis as the default position for tax assessment. So if you want to continue with the accruals basis, you will have to tick the box on the tax return to do so. I'm not really a fan of the cash basis because it makes the profits very sort of spiky over time, and you can have periods where you've got large income and costs are not aligned with it. So again, it's difficult to plan with that. However, there are some businesses that it may suit. So again, I would look very carefully at that. 3 is training costs. In the past, the revenue have had a very strict view of that. You had to show that the cost was wholly and exclusively for the purpose of the trade, and whilst that is still the case, it's been relaxed quite considerably, in that now it's likely that for costs or training courses or qualifications that you take, which in the past would have been treated as capital, you might get them now as revenue. There's 3 areas that they want you to comply with, and I'll just read those briefly to you. The first is improving existing skills and knowledge. The second, if there's an auxiliary knowledge gained within that, well, that wouldn't necessarily stop the claim. If it's taken to help the business run smoothly. The third is to improve the opportunities in your business. So that leaves the door open, I think, for formal qualifications to perhaps get a deduction for those. So if you're considering that's an area which I would look at very closely. The next one is CGT payable on disposal of properties within 60 days. This really refers to landlords and people with second properties. It is possible to avoid that by actually filing your tax return within that 60-day period. Not only would you will also avoid having to pay the CGT within the 60 days, because it can be deferred to the following 31st of January. It doesn't work in every case, so it's something you want to look at pretty carefully. The last one is related to limited companies, really, and it's the classic car way of probably getting some benefit out of the company at a very tax advantageous way, because if you buy a classic car, and remember you can have more than one car in the company, the benefit is calculated on its original list price. So for example, if you purchased a classic car that was over 20 years old and you paid maybe say 15,000 for it, and its list price when it was new originally was, say, 2,000. We'd probably need to go back to the 60s for that, but Assuming that is the case, then you know that's it. It would be calculated on that price and not the cash price now. So, so that is a considerable benefit. Remember to pay the private fuel element on it, because otherwise, you know, you will be caught for the fuel benefit charge, which takes away any benefit on that. Anyway, just some thoughts there. Thanks for listening.